Hi everyone. Today we're going to be talking about a recently launched India ETF, the Pacer ActiveAlpha India Quality ETF, ticker INDQ. The ETF was launched a few weeks ago, so we wanted to make a video about it. In this video, we'll talk about why India is an attractive option for emerging market investors in general. We'll talk a little bit about INDQ and what it's supposed to do, and then we'll compare it with much more vanilla India ETFs, such as the iShares MSCI India ETF, ticker INDA, and the Franklin FTSE India ETF, ticker FLIN. And just a quick reminder before we begin, this video is for informational purposes only, and it is definitely not investment advice. So before we dig into it, let's say something about India and why it should be on the radar of many emerging market investors. So first, India is the world's largest country with an estimated 1.5 billion people. In terms of growth, the IMF projects that India's real GDP growth 6.2% in 2025 and estimates it to be 6.3 to 6.5% in 2026, which keeps it among the fastest growing major economies. In terms of demographics, India has a very young population with more than 900 million people estimated to be under the age of 35. India also has a long runway, and the country's medium-term outlook is supported by private consumption, growing consumption in rural areas, and continued public investment. Since the 1991 economic reforms, India has moved away from a state-controlled economic model and toward a more market-oriented one, with broader space for private enterprise, trade, and investment. India is also embarking on modernization through digital political infrastructure efforts, which include systems that expand access to payments, identity verification, and services. The World Bank has highlighted India's digital public infrastructure as a major development in the country. So overall, India has a lot going for it in terms of emerging market economies, and it's structurally different from other BRICS countries and other large emerging markets. Now, let's move on to the Pacer ActiveAlpha India Quality ETF. INDQ was launched as a rules-based ETF that focuses on what Pacer and ActiveAlpha consider high-quality Indian companies. Pacer is the ETF issuer, and ActiveAlpha is the index and strategy partner behind the fund selection methodology. INDQ is much more selective than standard India broad market ETFs, which we'll talk about in a moment. The selection methodology for INDQ started with drawing from stocks from the Nifty 500 index, plus the Nifty Microcap 250 index. Then it goes and narrows down the companies through a series of screening protocols. According to our reading of the prospectus and what the ETF is trying to do, the screening process emphasizes quality. It looks at metrics such as return on equity, return on capital employed, return on assets, and free cash flow stability. It excludes firms with debt-to-equity ratios above 1 and screens out companies that have weaker governance signals. After that, the index applies a value screen comparing valuations in companies over 5-year historical averages. Then it applies a momentum screen using 12-month price trends adjusted for volatility. The final product is a concentrated portfolio that aims to hold about 20 to 30 stocks. It's thus not giving you broad India market exposure, but it's giving you a high conviction basket of Indian companies selected through quality, value, momentum filters. The current expense ratio is 0.88%, making it a bit high for geographically focused ETFs, and the index is rebalanced quarterly. Weights are tied to companies' composite score with a maximum weight of 5.7% and a minimum weight of 2%. This means it's a passive rules-based ETF that regularly rebalances. So in short, this is essentially an ETF comprised of select stocks that passed screens set by the fund managers and is supposed to give you exposure to Indian equities that will hopefully outperform the general benchmark index. Now, if we compare INDQ with INDA and FLIN, which are far more vanilla ETFs, we can see the differences between them. INDA tracks the MSCI India Index from iShares, which is a broad, large, and mid-cap India benchmark, and iShares says it's meant to give investors exposure to large and mid-cap companies. FLIN tracks the FTSE India RIC Capped Index, and Franklin describes it as providing exposure to large and mid-cap Indian companies as well. They're both trying to give investors core exposure to large and mid-cap stocks, but they track different indices, so the details and fees are not identical. INDA and FLIN are much broader. As of April 2026, INDA currently held 164 stocks and FLIN held 273. However, INDQ by design is far more concentrated and aims to hold roughly 20 to 30 companies. Thus, while INDA and FLIN give you broad market exposure, INDQ is a factor screen product. So with INDQ, you're basically getting a tighter basket of Indian companies that score well on quality, value, and momentum. INDA and FLIN are heavily influenced by India's biggest companies and sector weights. For example, iShares shows that INDA's largest sector holding is financials at 28.86%, with the top holdings including HDFC Bank, Reliance Industries, and ICICI Bank. The same is true of the Franklin FTSE India ETF, although it's slightly different amounts. INDQ, on the other hand, is built to look quite differently from these standard benchmarks because it's not simply a market cap weighted ETF across the board. It's actively trying to tilt towards more focused companies. This means that the ETF will also have tracking errors versus the normal Indian benchmarks, but there's also potential for greater returns if the basket performs well. So INDQ is basically a concentrated smart beta India ETF, while INDA and FLIN are standard broad India ETFs. So what to make of INDQ? INDQ seems to be a recently launched ETF that deploys a rules-based strategy that aims to target specific equities that fund managers believe will beat the market. The fund is brand new, so there's not much performance data behind it, but it will be very interesting to see how it performs over time. For average retail investors, it's going to be important to think about a few things. First, most of us know that fund managers don't often outperform the market, so whether the INDQ managers will outperform the market or not remains to be seen, and it's something that we should be careful about. Second, we have to also consider the added expense ratio and determine whether it's worth it. INDQ currently has a 0.88% expense ratio, while INDA and FLIN, more vanilla options, are both lower. INDA being 0.61% and FLIN being 0.19%. And finally, you have to think about how India is going to fit into your broader portfolio strategy. There are a lot of good things that India has going for it, but there are risks that come with India as well. Plus, geopolitical tensions are never something to ignore, and there's no telling what could happen in India domestically in the near future. Thus, the extent that you may want to have exposure to India will differ depending on your goals and how you personally feel about India moving forward. That being said, hopefully this video got you thinking about the different ETF options available if you want to invest in Indian companies. Thank you for watching our video. Please check out Vina Edge, our website and channel, for more information on emerging market investing and living. And once again, this video is for informational purposes only, and it is definitely not investment advice.